The quest for a perfect trading system, one that delivers profit on every single execution, is a foundational misconception that prevents most traders from achieving consistency. This video will dissect the breakout trading strategy that works every time by redefining what works truly means in the context of professional risk management and statistical expectancy. We must first accept the statistical reality of the markets. No single trade or strategy wins 100% of the time, and any system promising such results is fundamentally flawed. The objective of any successful trading approach is not a flawless win rate, but rather a positive expectancy system that generates profit over a large sample size of trades. The famed trader William Eckhart once stated that the success rate of trades is the least important performance statistic and may even be inversely related to performance. This profound insight immediately reframes the success metric away from individual trade outcomes and towards systemic profitability. Focusing solely on win rate often leads to strategies that capture small, frequent profits but are ultimately destroyed by a single, large, catastrophic loss. Legendary foreign exchange trader Bill Lipschutz echoed this sentiment, noting that traders can be profitable, being right only 20 to 30% of the time, by rigorously focusing on the reward-to-risk ratio. The strategy presented here is specifically designed to consistently maximize this ratio and eliminate low-probability fake-out moves that plague amateur traders, ensuring long-term capital growth. The first critical step in executing this high-probability breakout strategy is the accurate identification of defined high-quality consolidation patterns. Consolidation represents a period of institutional indecision, essentially a coiling of market energy that is ready to be released in a directional move. The power of a defined range is its ability to clearly delineate key levels of support and resistance that have been tested multiple times by the market. The longer these support and resistance levels have been in play, and the more times they have been respected, the better the outcome when the price finally breaks out. The most reliable breakout formations are those that represent significant accumulation or distribution, clearly showing the market's underlying intent. These patterns are not arbitrary lines on a chart, but clear visual representations of supply and demand dynamics in temporary equilibrium. Recognizing these specific structures is what separates random entries from calculated high-edge trades with defined risk parameters. We will focus on 4 specific formations that consistently deliver the best breakout opportunities and the cleanest risk definition for professional trading. The first reliable pattern is rectangular consolidations, also commonly known as simple trading ranges. These are well-defined horizontal boundaries where the price repeatedly bounces between a clear support and a clear resistance level. The range must be observed over a significant period, typically 20 or more price bars, to ensure its structural validity and significance. This pattern signals that buying and selling pressure are temporarily balanced, and the market is preparing for a decisive directional move once the balance is finally broken. The longer the price remains contained within this rectangular box, the more explosive the resulting move is likely to be upon breach. The second highly reliable formation is the ascending triangle car pattern, which signals building bullish pressure. This pattern is characterized by a horizontal resistance level combined with a series of rising higher-low swings in the price action. The higher lows against the static resistance signal that buyers are consistently stepping in at increasingly higher prices, absorbing all selling pressure before it hits the support. A breakout above the horizontal resistance line in an ascending triangle is often swift and confirms the significant accumulated buying pressure. The descending triangle is the inverse, featuring lower high swings against a horizontal support level, signaling increasing bearish momentum and building pressure for a breakdown. The third set of reliable patterns are the bull and bear flags, which are recognized as short, tight consolidation periods following a strong, almost vertical directional move. A bull flag features a slight downward sloping channel after a strong uptrend, indicating a pause where early profits are taken before the main trend continues its trajectory. The bear flag is the opposite, displaying a slight upward sloping channel after a strong downtrend, signaling a brief respite before further aggressive selling pressure. These patterns indicate a pause for continuation rather than a full reversal, and they offer excellent reward-to-risk ratios due to the strength of the preceding momentum. The fourth pattern, a favorite for long-term trend capture, is the cup and handle pattern, which is a long-term pattern that shows a significant base formation. The cup is a rounded bottom, signifying a gradual fundamental shift from selling to buying pressure over an extended time frame, often several months. The handle is a smaller short consolidation or pullback near the rim of the cup, providing a final low-risk entry point. The breakout occurs when the price moves decisively above the rim of the cup, confirming the significant base of accumulation and long-term shift. This pattern is highly reliable because it reflects a deep, fundamental, long-term shift in market sentiment and institutional accumulation. Once a high-probability consolidation pattern is identified, the absolute critical factor that separates a genuine breakout from a low-probability false signal is the confirmation filter. This filter consists of two primary non-negotiable components: volume analysis and momentum candle analysis, both of which serve to confirm the institutional footprint. Without confirmation from significant market participation, any price move outside of a range should be treated with extreme skepticism and caution by the disciplined trader. The volume spike is the non-negotiable evidence that large institutional money is driving the move, providing the necessary conviction and staying power. Volume, the institutional footprint, is the first confirmation and must be present for a trade to be considered valid under this systematic strategy. A true breakout must be accompanied by a significant and unmistakable volume spike that clearly stands out from the recent trading history. A specific and measurable data point is required to remove all ambiguity from this observation, turning a subjective judgment into an objective, rules-based entry criterion. Traders should look for a volume spike greater than 150% of the 20-day average volume, or a volume level significantly higher than the previous several candles. The use of the on-balance volume, OBV indicator, is an invaluable tool to confirm the underlying buying or selling pressure that often quietly precedes the final price move. The OBV is a simple cumulative indicator that adds volume on up days and subtracts volume on down days, essentially tracking the flow of money in and out of the asset. An ideal high-confidence scenario involves the price consolidating while the OBV line begins to trend higher, showing quiet, unseen accumulation by institutions before the price breaks out. This positive divergence between the consolidating price and the rising volume is a powerful indication of impending directional movement and strong institutional intent. The second part of the confirmation filter is momentum candle analysis, which judges the conviction and strength of the move as it happens in real time. A true breakout move should be executed with overwhelming power, not with hesitant, small price fluctuations, and this conviction is clearly visible in the size and form of the breakout candle. The specific method requires looking for momentum candles that are at least 2 to 3 times the size of the average candle that preceded the breakout. These large-bodied candles demonstrate overwhelming directional conviction, often closing firmly outside the established breakout level, with minimal or no upper or lower wick. These large conviction-filled candles act as a clear statement of intent from the market, confirming that the new directional bias is being established with undeniable force. A small-bodied candle with long wicks poking outside the range, on the other hand, is a classic, high-probability sign of a false breakout or a distinct lack of conviction from major market participants. The combination of the volume spike and the decisive momentum candle creates a powerful objective filter that eliminates the majority of low-probability fakeouts. This stringent confirmation process is what transforms a simple price breach into a high-confidence, high-edge trading opportunity. The third step focuses entirely on the entry technique, moving past the common, costly mistake of entering immediately upon the initial price breach of the range. Entering immediately on the initial break is known as the breakout entry trap, because it often leads to failure due to two main recurring reasons: the high probability of a false signal and the potential for high slippage on the trade execution. A significant percentage of initial breakouts ultimately fail, reversing back into the original range, and trying to chase the immediate move often results in poor execution prices. The most successful professional traders understand that patience is the ultimate non-negotiable edge in this critical phase of the trade. The break and retest strategy is the single most reliable entry technique for achieving higher probability and superior risk definition in a breakout setup. Instead of chasing the initial move, the disciplined trader waits for the price to pull back to the broken support or resistance level, utilizing the fundamental principle of polarity. The principle of polarity dictates that once an important resistance level is decisively broken, it now fundamentally becomes a new support level, and conversely, a broken support level becomes a new resistance. This retest acts as a vital secondary confirmation, proving that the market respects the new dynamic and the institutions are willing to actively defend the converted level. The specific method involves waiting for the price to touch or come very close to the retest level and only entering if the level holds and the price begins to move back in the original breakout direction. This patient pullback to the retest level provides an exceptionally clean and tight stop-loss placement, which directly and mathematically maximizes the potential reward-to-risk ratio. The retest entry is the defining characteristic of professional breakout trading, offering vastly superior execution and confidence compared to the amateur's immediate chase. This systematic, patient approach is the key to unlocking the true, profitable potential of the entire strategy. An advanced entry tool that can be utilized to further confirm the strength of the retest and help define the ideal, most precise entry point is the volume-weighted average price, VWAP. Indicator, the VWAP is a trading benchmark that represents the average price of an asset over a specific time frame, weighted by the volume traded at each price point. If the price breaks out and then retests the old resistance level, a high confidence entry occurs if the retest also coincides with the current VWAP line. This powerful confluence of the structural retest and the volume-weighted average price provides a robust, objective signal for trade initiation with maximum precision. The final step is the risk management framework, which is the true non-technical mechanism that makes the strategy work every time, ensuring long-term sustained profitability regardless of short-term volatility. Without an ironclad, rigorously applied risk management plan, even a strategy with a high theoretical win rate will ultimately fail due to one catastrophic, unrecoverable loss. The most fundamental and absolute principle is the Fayet's capital preservation rule, which dictates the maximum exposure allowed on any single trade setup. The specific rule is that a trader should never risk more than 1% to 2% of their total trading capital on any single trade setup, without exception. This strict limitation ensures that even a long, unfortunate string of consecutive losses cannot wipe out the trading account, preserving the ability to continue trading and benefit from the strategy's positive expectancy. This rule is non-negotiable and represents the single most important factor for a trader's longevity and ultimate success in the market. Consistent, disciplined application of this rule is the absolute core of professional trading discipline and capital management. Logical stop-loss placement is the next crucial component, and it must be based solely on the technical structure of the market, not arbitrary dollar amounts or percentage drops. The specific method is to place the stop-loss at a price level where the original breakout thesis is clearly and unequivocally invalidated by the price action. This point is typically just inside the range of the pre-breakout consolidation pattern, ensuring that if the price returns to the range, the trade is immediately and logically closed. Placing the stop loss logically ensures that the trade is only exited when the market proves the initial analysis wrong, not due to random market noise or fear. Finally, the system requires a minimum profit expectation defined by the minimum reward to risk ratio. Before a trade is even considered for entry to maintain a positive expectancy, the strategy demands a minimum 2-to-1 reward to risk ratio, meaning the potential profit must be at least twice the potential loss. This specific target ensures that even a trader with a 33% win rate can break even, and anything higher will result in substantial net profitability over time. The exit strategy should utilize technical targets, such as measuring the distance of the consolidation pattern and projecting that distance from the breakout point. A prudent approach is to consider taking partial profits at the 1-to-1 reward level, effectively securing some initial gain from the move and reducing exposure. Upon taking partial profits, the stop loss should immediately and systematically be moved to the break-even point, eliminating all risk from the remaining position. This tactic ensures that the trade becomes a free trade with zero risk to capital, allowing the remaining position to run for the full technical target or a trailing stop loss, maximizing the capture of a large trending move. This systematic approach to profit management is the final essential piece of the profitable breakout puzzle. The application of this systematic breakout strategy requires immense discipline and a commitment to continuous learning, especially when the market becomes challenging or volatile. Trading can often feel like a solitary, difficult endeavor, and it is during those times of wavering confidence that a strong community and a wealth of educational resources are most valuable. Please take a moment to subscribe and leave a quick comment below, even just a single word or a question. This simple action greatly helps the algorithm recommend this video to more people and shows me that this kind of analytical, data-driven content truly matters and is worth the extensive effort to create. And please do not forget to return to the channel during challenging times when trading becomes difficult and your confidence starts to waver, as the content here is specifically designed to reinforce your discipline and strategic framework. Your subscription is not just a number, it is a commitment to your own trading education and a sign that you value a professional, non-hype approach to mastering the financial markets.